The stock for Beyond Meat Inc., ticker BYND, is currently trading at $1.14, reflecting a decrease of 0.08 cents, or approximately 6.56% during intraday trading on December 9, 2025. This significant daily loss immediately challenges the narrative that the extreme October volatility, which briefly saw the stock surge on meme stock characteristics and a short-covering frenzy, marked any sort of sustainable bottom or fundamental turnaround. The reality is that the stock is now testing the lower boundaries of its post-frenzy range, suggesting that the broader market is rapidly shedding the speculative heat and reverting to an assessment of the company's challenging underlying business conditions. This recent daily plunge is not an isolated event. It's a clear signal that the underlying bearish pressure, which has been building for quarters, has reasserted itself now that the emotional trading is fading. Common market expectation for Beyond Meat has largely oscillated between two extremes. Either the company is a world-altering pioneer destined to become the next dominant packaged food brand as consumers shift to plant-based diets, or it is a failed experiment, an early public offering victim of a peak hype market that never established true scale or profitability. The reality, which sits uncomfortably between those two poles, is far more complex and involves a deep restructuring under the hood that has been masked by dramatic short-term price swings. The recent price action, particularly this drop back into the dollar range, suggests that the market is finally moving away from the meme stock label and refocusing on the dismal financial performance revealed in the most recent quarterly report. This is where the tension lies. Investors want a quick, exciting comeback story, but the company's path is clearly one of painful, protracted cost-cutting and a battle for relevancy in a category that has cooled considerably. Looking at the immediate stock movement, the current 6.56% decline is happening on volume that, while not as explosive as the October peaks, is still elevated compared to the pre-squeeze baseline. This indicates a definite institutional flow, a continued unloading of positions, or a significant lack of fresh buying interest to counter the selling pressure. The recent third quarter 2025 earnings report, which was delayed and then accompanied by news of a whopping $110.7 million net loss, a massive jump from the $26.6 million loss a year ago, remains the key anchor dragging the stock down. Specifically, the impairment charges of $77.4 million related to long-lived assets and the complete suspension of operations in China revealed a company pulling back hard on past ambitions. While revenue of $70.2 million technically beat an already lowered forecast, the wider loss and the grim commentary on market demand, particularly in the U.S. retail and food service segments, painted a bleak picture. This continuous weakness in consumer demand, especially in the US and Europe where sales volume is down significantly, is fundamentally what is driving the stock lower today. The macroeconomic pressure on consumer spending means shoppers are trading down, and premium-priced plant-based meats are often the first to be cut from the grocery list. The institutional activity surrounding Beyond Meat is telling. Following the disastrous Q3 report, firms like Mizuho and Barclays slashed their price targets to as low as $1, reiterating underperform and underweight ratings. This mass exodus from conviction suggests that professional money managers see little near-term incentive to own the stock regardless of its low absolute price. The analysts are simply factoring in sustained revenue declines and the fact that profitability is nowhere on the immediate horizon. They are looking past the short-term volatility to the structural problems, such as a gross margin that plummeted from 17.7% to 10.3% year over year. This margin erosion is a powerful signal that the company is struggling not just with demand, but also with the cost of goods sold and the efficacy of its production model at lower volumes. Now, we must look squarely at the short-selling awareness, as this is the engine of the stock's recent theatrics. Beyond Meat has been a favorite for short sellers for a long time, and the data remains compelling. According to the most recent official figures, the short interest as a percentage of the float is still exceptionally high, sitting at over 21% based on Nasdaq data, though non-official trackers have placed it even higher during the peak volatility. While this is down from the peak short interest percentage during the October squeeze, the total number of shares short remains substantial, hovering near 93 million. What is particularly notable for retail investors to track is the days to cover metric. This figure, which indicates how many days it would take short sellers to repurchase all borrowed shares at the average daily volume, was recently very low at 0.71 on one exchange, a figure that can fluctuate wildly with the dramatic changes in trading volume seen in November. This volatility in days to cover means that while a large short base remains, a true, massive short squeeze that catapults the stock back to double digits becomes less likely as the average daily volume remains high. The shorts can cover relatively easily without causing a panic. Furthermore, the short borrow rate, the cost for short sellers to maintain their positions, has been reported in the high double digits, around 26% recently. This high cost is a direct financial drain on the bears and acts as a pressure cooker. They need the stock to drop quickly to profit before the interest payments eat into their gains. If the stock trades sideways or moves up even slightly, that high borrow rate forces a decision to cover. Retail investors looking for actionable insight here need to monitor this borrow rate and the available short shares daily. A sudden spike in the borrow rate, coupled with a drop in available shares, suggests the tension is building again. However, the short thesis, pushed by notable institutional short firms, centers on the company's lack of a durable competitive advantage. The massive cash burn, the over-dilution of shares from the recent convertible debt exchange, which involved issuing 318 million new shares to cut debt, effectively transferring a significant portion of the company's ownership to former bondholders and gutting shareholder value, and the declining consumer interest in the core product. Retail investors must differentiate between a short-term trading signal and a long-term investment thesis. The high short interest is a signal for volatility, not an endorsement of the company's value. I want to know what you think. Do you think Beyond Meat's financial reality justifies this level of short pressure, or are the shorts simply capitalizing on a temporary market slump? Comment below with your honest take on the short thesis versus the long-term potential. The foundational business of Beyond Meat is the manufacturing and distribution of plant-based meat substitutes, primarily sold through retail channels like grocery stores and through food service partners such as restaurants. Their initial competitive edge was a strong scientific focus on mimicking the taste and texture of animal meat, which allowed them to cross the chasm from niche vegan markets into the mainstream fresh meat section of supermarkets. They were masters of brand marketing in the early days, leveraging a clean label, environmentally conscious image. However, the plant-based protein category has seen a massive surge in competition, from established food giants like Kellogg's and Tyson Foods entering the market, to private label alternatives that undercut Beyond Meat on price, which is a lethal combination when consumers are price sensitive. Their business model struggles acutely with scale. They built a production and distribution system for a high-growth market that simply hasn't materialized to the extent anticipated, leading to massive underutilization of assets and the consequent need for those huge impairment charges on long-lived assets we saw in the last report. From a future outlook perspective, the company's management is currently focused on survival and balance sheet repair. CEO Ethan Brown has pointed to the debt restructuring as an important resetting, which is corporate speak for "we staved off the worst-case scenario at the cost of massive shareholder dilution." This is the core expectation